Hey traders, welcome to CNBC's Trading Nation. I'm Todd Gordon, and today we're taking a look at the S&P, and we're going to talk about the 50-day moving average. Basically what that does is it's basically a 2-month moving average, right? You have about 22, 23 trading days in a month, so the 50-day winds up being about a 2-month average. Now, there's something interesting that the S&P is doing with this 50-day moving average. First thing you'll notice is we've just recently seen a close below the 50-day moving average. And as we scroll in here a little bit, that first red candlestick with a thick body below that blue line, this guy right here on the April 13th, that's the first close below the 50-day moving average after an extended uptrend in the stock market. Okay, so that's where this little piece of analysis begins. Let's look at past examples of what happens to the stock market after we get a close below the 50-day following an extended advance. All right, so let me just scroll back here a little bit. Now, the last time we saw a close below the 50 after an extended advance was right here on this pretty big gap right down there. We saw a pretty good rally ahead of that gap. And what you'll see is this first period of consolidation following the close below the 50-day to the point at which we reemerged back above the 50-day. This particular example, we got the rally up through the November election, that lasted 59 days, okay? So let's scroll back now. I'm just checking my notes. All these stats I'm gonna throw a lot of numbers at you. The May was the last example, May example right here. So we closed below the 50-day right here in May, chopped around for a good period of time before we finally regained the 50-period moving average on this bar. That wound up being 47 trading days. I've got one more example for you. That's going to be at the very end of December of 15, heading down into 2016, the early goings. First time we got to close below the 50 after an extended advance was right there. That wound up being an 82-day period of back and forth before we finally regained the 50-day, which is right here on this bar. So what that means basically is you take those three examples of the 50-day, stopping the uptrend, putting it into sideways consolidation, and then regaining the uptrend at some period later. The average is about 62 days. The point here that I'm making is we've just broken back below the 50 after an extended period of uptrend. The problem is we've just done it several days ago on this bar right here. So if history is to serve as any indication as to what's to happen in the future, we might have approximately 63 days of sideways back and forth here. And with all of the political, fundamental, monetary policy, fiscal policy, all the data that's being thrown at the markets are right in the middle of earnings season, kind of makes sense the market doesn't know what to think of it. So for me, guys, I'm careful buying breakouts and selling breakdowns. I'm going more towards a range-bound strategy, taking in option income. All right, guys, I just wanted to put that little piece of analysis in front of you in the S&P 500. For CNBC's Trading Nation, I'm Todd Gordon. Good luck on the markets going forward. If we are to stay range-bound, be sure to follow us at Trading Nation on Twitter, and we will keep you updated as to all the market observations we're finding. See you guys.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.